All right, guys, here we go. The purpose of this video is to point out and show you the many similarities and correlations of today's market as compared to the years going up into the 1929 market crash, which, of course, eventually led to the Great Depression. But a little backstory, history to that is that, the 1920s, we had just come out of World War One, the war to end all wars. The Industrial Revolution was taking off. Small appliances, automobiles, oil. Everything was booming. Everybody was making money. Multi generational wealth was made during that time. Also, very low interest rates, things of that nature. So let's get into it and let's see what their downfall was, and can we learn anything from that? And as we go down this list, economic events leading up to the 1929 market crash, I think you will see almost 100% of these are, currently going on or have leading up into, our current situation. Unemployment rising. At one point in time, 1 in 4 Americans were unemployed. Automobile sales were falling off sharply. Department store retail sales revenue were declining leading up to the 1929 market crash. Small business failing across America, especially farmers, as people came in. And also, as history looks back, it was because of bad lending by the banks that caused a lot of this. Or was it on purpose by the banks to make these type of loans to farmers in order to get their land? I don't know. Leave that up to you. Financial speculation, you know, get rich easy schemes are all over. A lot of Americans during that time were scammed by con artists all over America. Investors buying stocks on margin. Where have we heard that before? Many put down as little as 10%, and they borrowed 90% on the cost of the stock, which is, just ridiculous. Next, we see the wealth effect on consumption. Obviously, when people's wealth starts coming down, they spend less, consume less, which has a trickle down effect, to small businesses, etc. Now we got to put a little blame on the Federal Reserve, okay? They increased the money supply between 1921 and 1929 by 67%. And actually, they were going out and printing dollar bills as high as 5,000, 10,000, up to $100,000 bills, okay? Policies that led to declining interest rates, which encouraged people to borrow and overinvest, okay? Borrowing way more than they probably should have. And that leads to highly speculative, higher risk on investments, which, as we know now, never ends well. Fast, easy money, easy monetary policies with low interest rate and unchecked speculation. And then leading up to when there begin to be, cracks in the dam, so to speak, leading up to actually just the week before, the major crash started happening. The next week, a consortium of bankers came together. J.P. Morgan was one of them, and they put hundreds of millions of dollars into the market. And then after it stabilized for a couple of days, guess what? They pulled it out, and that was like pulling out the plugs in the dam. Everything collapsed. But even during the collapse, the New York Times and a lot of these big bankers were coming out and saying, "Hey, it's just a temporary setback. Things are going to stabilize. We have a great market, a strong market, and this is really just going to affect the luxury, retail market." And then also, what led to the blocks just totally crumbling out beneath the foundation, where the banks were not totally financially secure, and they didn't have the backing or the stability as they advertised. They were saying one thing, and behind closed doors, the numbers, were definitely a different amount. And the banks had loaned out during that period of time, over a 10-year period of time, $8.7 billion, which now doesn't seem like a lot, but it was a big deal back then. And that circulation of funds and it ended up backfiring on them in 1929. Just so much money out there, in bad loans or in bad investments. And then the massive buildups in inventories. Okay. And we have, seen that as well. For example, consumer items, there was a 300% increase in just, radios and toasters back then. As small businesses and bigger businesses were just churning out all these things that people wanted, but slowly, the market got saturated, but they kept producing them, which led to that buildup in consumer goods. And then a couple little points here 1929 to 33, over 100,000 businesses failed. From 29 to 33, 6,000 bank failures. And, the people's money in there, if they were even the good people that were trying to save their money, lost everything. And that's why it was such a huge hit on all Americans across America. And then, of course, 1930s unemployment hovered around 15 to 25%, which was huge. But okay, guys, let's go to the charts now. We'll show you a few things leading up to the great crash and how you could have saved your great grandfather's money. All right, guys, here we go. Looking at the Dow Jones chart, and actually it goes back. Data starts getting on here around the late 1800s, and then the early, of course, 1900s, and even leading up to the Great Crash of 1929, from 1901 to 1903, we had a 46% pullback. And then from, '06, 1906, 1907, 48% pullback. So yeah, in the high 40% area. Then even as late as 20, let's see here, 1919 into 1921, had a big pullback here, 46%. But let's look at the 1929 crash. And as you can see here, leading up to it, this was all multi generational family wealth here being earned if you were playing your cards right. And then right here was multi generational family, uh, wealth being lost. Okay, so it's very important to, I think, teach your kids, grandkids, at least the basics of this sort of thing, so that obviously, what takes two or three generations to build can be lost in one. And it's just some, basic training, education could help, prevent that. But anyways, you can see, I'll give you some free information here. Whenever the 20 and the 200 come together, 100% of the time they'll separate far and away from one another. And then on the opposite end, when they're far and away, 100% of the time they come back together. It doesn't matter if you're on a 2 minute chart, each candle, playing out 2 minutes, or on a monthly chart like this. Each candle here is 1 month of price action. And the blue line is the 20 month, meaning it's the average closing price of the last 20 months, and the 200 is the closing price of the last 200 months. So kind of give you an idea if you're new to all this. And then, as you can see here, we were on this huge uptrend, basically pretty much uh, parabolic here. So the easy money, getting money on, buying things on margin, maybe not getting into the best companies, best stocks, probably led to a lot of people's downfall. Even really good companies, long-standing companies that are still in business today took huge losses, as you can see. Okay, and then also about this chart here, there's always indications of a market failure coming around. Nothing crashes overnight. They say, well, you've heard people say, well, the market crashed overnight. Well, not really, unless there's a black swan event or some sort of, uh, uh, you know, major issue out there. But even before that, you'll see, cracks in the surfaces. And one of the things we notice here is that one of the tricks they do, whenever you see this sideways consolidation zone, another absolute. First of all, there's a handful of absolutes in the market, okay, that happen 100% of the time. Doesn't matter uh, what, okay. One of them is that 20 and 200 when they come together. Price will fall, 20 will go under the 200, or as you can see here, price will rise, and the 200, the 20 will come up far and away from the 200. Also, another absolute is when price starts getting far and away from the 20, you want to start thinking about scaling out, getting out. Things are overheated. Let me well, first of all, let me show you this just real quick. I don't mean to bore you here. This is real important. Normally, three hits, you'll get rejected. When price is under a trend line, as you can see here, one, two, three, rejection. And then on the fourth or fifth try, it'll break through. Same on the bottom, one, two, area, three, and then it'll broke out. So let me take all this off, clean up this chart for you. And then another absolute. Every time there's consolidation, 100% of the time, price will break to the upside or downside. So when you see consolidation, hey, just sit back, relax. The market's getting ready to tell you what to do. Just like Mother Nature, and market's always right. Right through here, consolidation. It broke out on this candle. That was Monday, June 3rd, 1929. And a lot of times, well, first of all, this sideways consolidation is either accumulation or distribution. Okay, even back then, people were charting. They had to do it by hand, obviously. No, computers back there. And of course, the candles are from hundreds of years ago from the Chinese rice traders that would draw these candlesticks to determine the market and be able to forecast potential prices on rice. But anyway, this breakout candle right here that we talked about, that was, obviously, hindsight's 2020, but those that know, okay. And what I mean is, a lot of times when you're far and away from the 20, what they'll do, they'll put in a breakout candle, and people go, "Oh my goodness, we're getting ready to go to the next level," so they'll jump in, and that gives as the price is going up, that'll give the institutions, the smart money, opportunity to what sell into that pump. Okay, and you'll see this a lot of times if you day trade, but they'll be consolidating after it's run a pretty good while, like half a day or almost all day or whatever, and then they'll put a big green candle in there, bullish and what we call bullish engulfing clearing takeout candle like this one, because it wipes out everything, to the left here. But anyway, and then that'll, suck everybody in. The next thing you know, the next candle or two, boom, here you go to the downside. And then also here, if you had just played, uh, you've heard the stories about, people with huge sums of money that made it during the industrial revolution and with whatever commodity or appliance or automobile or whatever, they were traveling the world, and they weren't able to sell out, get out of the market, and by the time they got back, they were in financial ruin. Of course, you made it once, you can try and make it again. But anyway, if they had just told their friends, family, business partners, whatever, hey, if the market when the market gets close to the 20, and then you get a big market push, green candle, okay, scale in more. As you get away from the 20, start scaling out, and then especially 100%, if you start trading under and closing candles under, yeah, it's that simple, okay. Start scaling out, maybe 10%, each candle, or 20% each candle, or whatever your risk management is. And just by doing that simple deal, just selling under, buying on top of the 20 as it hits and then moves, and then selling under the 20, each red candle it puts in there. See right here, let me take all this off so you can see it. Let's say you're doing 10%. Here's 10, 20, 30, 40. You've been 50% out right here. And then I'll just go ahead and give you this little tip. Whenever you see a big red candle, no matter if it's on a 2-minute chart, daily chart, whatever, and you get two green candles closing up into it that do not pass. The lower the better. If it's in the lower end of the candle, lower range of candle, the better. The higher the odds, higher the probability this next candle is going to be red, and you're going to get explosion to the downside. Okay. So anyway, but yeah, by around at least by in here, you would have been absolutely out. Now, you can check this out. Of course, hindsight's 2020, but you can check me out. Look at years back on Twitter, years back on YouTube. Been preaching this forever. If my family had been in this thing or currently in the markets, we're going to know how to get the bottom and uh, start scaling out the top. Let me show you how. Okay, there's well probably really four reversal patterns, but the two main ones, the two strongest ones, and then I'll show you the best one, is the V shape like this, and y'all all have heard of that, seen that. The next one is this W, and it's the strongest, most reliable one. Okay, especially when it comes back, hits the 20, and the 20 holds, and then you move from there. Okay, so the V and the W, okay? And why is that? Well, one of the reasons is that you had a low pivot here, hammer candle, a bullish engulfing takeout candle that took out all this. And then you came up and then you ranged down, made a higher low. Okay, right there, especially this candle here. That was the go-to, the money candle, whatever you want to call it, because we made a higher low. Number one, number two, you closed over that 20, and then you just kind of came up, melted back in to the 20, and then we had consolidation here, and then you broke out. And normally it happens on the fifth candle. Okay, so whoa, so guess what? One, two, three, four, fifth candle. I mean, you can't make it this up. I mean, we've been doing this forever, and I'm just saying, of course, no no one here was back in 1935, but I'm just saying how how markets are the same. The reason why it's all the same. Humans are the same. Greed and fear. And I think the greed sometimes overtakes the fear. But anyway, there was something else I was going to show you in here. Yeah, okay. People, I have this at the top up here. It took about 20 years for us to make an all-time high again. Okay, but was there money to be made in here? Yeah, you can see it. Did you have to sit on the sidelines for 20 years? I mean, there's some influencers out there saying, "Oh, we're not going to make market highs again after we dump. We're not going to make another market high for 10, 15, 20 years." I don't care. There's bottoms to be made. We'll find the bottom. Okay, and then we're gonna ride. We're gonna know where to get in, where to get out. We're gonna know our moving averages, et cetera, and how to play this game. So anyway, here we are, current day, and I'm just pointing out the other big, you know, push to the downside, 47% back here in the 70s. Uh, well, then the late 80s, 41%. Here's, I think, the 2007. Oh, the 2000. Okay, talk about parabolic runs. See, they say, uh, people that don't know say, well, crypto's a scam. Nothing runs parabolic. Okay, tell me that's not a parabolic run right here on the .com bubble. Okay, that's why it was so horrific on the pullback. But even the pullback was less than 40%. Okay, and then look at that. It's almost like a V-shaped recovery. Then you come up here, the bankers, mess us up again. I guess we didn't learn anything from 1920s, 1929, 33, 53% pullback here on all that savings and loan and all that other scam. And again, I have that little white line here. See, you're far and away from the 20. One, two, three hits, and then you come down. Uh, you retest that line, you can't do it. And then boom, look at that, you're stuck under the 20. So one, two, three, four. There's four times you had to get out. Four red candles on the 20. Ended up down here. They came back in, did a V-shaped recovery for you, and you're off to the races again. Of course, it took you way over here about March of 2013 before it hit the all-time high and broke out. But is there money to be made in here? Yeah. Okay. So, enough about that. And then the COVID slammed down 38%. And here we are now, present day. Okay. Again, this trend line, one hit, two hit, here's the third one. And then we finally, made it over, came back down, hit this high pivot here of support. And that's not by coincidence. Okay. At a high pivot here, previous resistance, institutions coming in supporting it here in November of 2020, came back up. And then here you go, retesting it again. And then here we are above the trend line, above the 20. So time will tell, if we can come up here. I mean, we're a lot closer to hit, the retest the all-time high than we are coming down here, hitting the 200 or this double bottom here in 2020. Do I think the markets are going to pull back? Sure. Like I said before, like right here. Okay. Again, the 20 and the 200 come together. They always do. I mean, it took, right here, 82 from 1982 that came together, that finally started separating. And then in 2010 came back together. Will we put in that many years again before we come together? Who knows? But that's a pretty wide distance apart. Only thing I know, we will be coming back down into it. And if we start failing, matter of fact, I'll show you a little secret here. The 50 simple moving average right here, 50 month. In other words, average close price the last 50 months. Last time, well, not the last time, the previous times when we started hitting it, once we got back over it, from the 2000, 7, 2008, 9 pullback, we hit it here, one, two, three, and it held each time. And then here we go on the fourth time. So if we hit it on the fifth time, high odds, high probability we're going to break through it, okay, and come on down. So that's what we'll be looking at. But right now, as you can see, the market, the institutions, Wall Street, whoever's controlling all this, definitely wanted to support the price at the 50. As we see here, here, and here at the COVID slam down, really only one candle closed under it. Again, most recently, only one candle closed over it. Then here we go. But all right, guys, I could talk about this all night. I appreciate you watching the video. Come check us out, follow us, whatever, on Twitter, and check us out on Patreon. And we will see you on the charts.